Rule 30, I talk about the market symmetry will prevail. And again, not just in terms of the two legs being in the same direction of comparable value. Occasionally you'll get a leg up and you'll get the inverted V pattern where you have the leg down. But still, the symmetry will prevail. You'll get the same amount down that you got to the upside, plus a few ticks to get the stops, and then it'll go back to the middle. Or vice versa. You get the leg down, you're looking for another leg down. Instead, you get a leg all the way up, taking out the highs, and only then coming back. So you'll be able to look back and see that perfect symmetry. And that's what I see happening in the market over and over again. It's the same thing that W.D. Gann, who was considered a genius, wrote about years ago, but he was difficult to understand, and anybody who studied Gann knows that. I had studied him for years and years, and even then gave up in frustration. But essentially, what I'm talking about here is the same thing that he had discovered so many years before, that there is a symmetry in the market, that the market will behave in certain patterns, and they're discernible to the people who put in the time to study these things and to find these patterns. And I think it's time well invested if you do that. And I talk about that here on Rule 30. The market that cannot fulfill its second leg in the direction of the initial leg will fulfill it in another way by retracing the entire move in the opposite direction. And I've seen this in terms of the morning and the afternoon as well. In other words, it's up all morning, it's strong as can be. In the afternoon, it gives it all back, so that the market is essentially unchanged at the end where it started from. Or it's down all morning, it regains it all back. Earlier in the year, when the S&P only knew one direction, which was up, anytime they knocked it down was an excuse for buyers to come in and take it up. That subtly will change over time. And if you're not going to get caught on the wrong side, you have to be sensitive to these subtle changes in the patterns of how it trades. And that's a real art form to be able to do it. But when you can, it's very satisfying, because what will happen, you're doing what you think is the right thing, and you lose money, and then you begin to lose confidence in yourself. But then the market will shift, and you'll see you did have the right idea. So you have to change your style of trading depending on what the market's doing, and the market continually will trade. For that matter, markets come and go over the years. Anyone who was around in 1987 knows what happened to the S&Ps there after the crash in 87. I went and traded bonds for a few years after that, and only then came back to the S&Ps when the market essentially came back. So you need to be aware of the symmetry and how markets change. And of course, like I said earlier, you've got to know the market you trade inside and out, so that the people you're competing with don't know it any better than you do. And so you know what a rally looks like. You know what a short covering a rally looks like versus the real rally. You know what it's like when they run the stops. You know the time of day when they run the stops. You know the time of day when the market runs. You know what a gap looks like that's going to be that you can fade. You know what a gap looks like where you shouldn't fade. And all these things become second nature after a while when you trade this way. And I want to stress too that you want to be able to go in the market with a certain amount of confidence every day that you know what the cycle pattern is like. In other words, if it's been up 3 days, we're due for a sell-off. How does it usually sell off? Well, it goes up in the morning on a gap, makes a high, and then it sells off late in the day and ends at the low. And then if you get a few days down, you know you're ready for a bounce. But again, the ability to see these things and capitalize on them are two different things. And to trade in a very satisfying manner, you have to be able to say, not only do I know what I'm doing, but I have the confidence to pick up the phone and go in there. And don't think that you're any different than anybody else in that respect, that everybody's on edge, everybody's worried, nobody has the confidence that you think the other guy has. Everybody knows that there's a certain amount of risk there, but they're able to withstand that risk and pick up the phone and go in the market, because that's what wins over time. And as I mentioned, the losses, of course, can be very detrimental when you don't trade in a proper fashion by doing things like letting the market get away from you. I mentioned this is the V pattern symmetry. A market that can't complete the normal pattern will often retrace it 100%. You got the V pattern, the inverted V. The completed patterns will often retrace 100% in the next trend. In other words, if it's up 400 points in the morning, it may come back 400 in the afternoon. Here's an illustration of that on page 151. You've got the V pattern. The morning decline is offset by the rally. You can see in the morning, these are on 5-minute bars. It went down into the noon hour, and then it staged a rally up into the close. And where did it go? Right where it's supposed to go, right over the highs, where the stops are. It's not an accident where it trades. Here's a case of, and I haven't spent much time talking about this, but this is important as well. How it traded yesterday is very important to how it trades today because, one, the close is what's called the value area. In other words, that's where, at the end of the day, the buyers and sellers were in agreement that this is where it should be trading. So what we had on the pattern on 152 was the prior afternoon rally was totally offset by the break on the next day. It rallied up. It came all the way back close to the lows. There was a little bit of a bounce. And, of course, it went all the way to the prior day's lows by about an hour into the day. So you have the perfect V pattern. Up on day one, all the way back on, gives it all back on day two. And here's an illustration on page 153 where you have a leg down, you have the equilibrium, you have a target buy on the downside, and the leg fails. And what happens when it fails? It goes the other way. And so into the noon hour, it rallies back up. What's it do? It makes a V pattern so that the symmetry is there. There was down, you were looking for more, it couldn't do it, so it turned around and went all the way back up. The market usually doesn't die on you. It follows through in one direction or the other. If it can't do it in the direction that you think it will, it'll turn around and go in the other direction. And this leads us to the whole notion of how do you trade something like this? You got to be flexible. You got to be willing to take losses, especially small losses, quickly and go the other way. And this is how professional traders trade. They're not wedded to the position. Just because they have an order in or a stop or whatever doesn't mean they can't pull it. It's also one of the reasons I don't use stops is that I don't want to be committed to doing something, especially when it comes within a short distance of the stop and you know they're going to get the stop. Why not call it in before it gets there? Or better yet, wait for a bounce and get out on the bounce. Rule 31 is be aggressive but stop reversing after 3 unsuccessful attempts. I mentioned that. I suppose you could make it 4 or 5 or 2. It's up to you. I just find that after I try 3 times and I lose on all of them, I'm in no mood to continue. And if I am, I start to lose the discipline. And who's to say that the fourth will work or the fifth or sixth? I've had days where I had a $500 loss, and by the end of the day, I'm looking at $10,000 in losses because I refused to give up trying to get on the right side. Now, of course, I have good days where I make that, but the point is, when you're having a bad day, you got to cut the losses somewhere, and that's a decision that you have to make. But the worst thing you can do is get on the wrong side and say, I'm going to stay with this through thick and thin, and it'll come back, because very often it never comes back. And I've seen people start out with $4,000 or $5,000 losses, and by the time they're finished, they lose $100,000. And there's no excuse for that. There really isn't. You've got to keep the losses small. And I know it's, again, commodity trading 101, but it's true. All the cliches are true. Keep the losses small, let the profits ride. So what's the average guy do? He lets the losses ride and he keeps the profits small because he tells himself you can't go broke taking a profit. Well, in the futures market, believe me, you will go broke taking small profits, and especially if you have large losses. So you need to have the big days when you get on the right side and you make a lot of money, and then you make them take it back in little bitty pieces. One time a few years ago, I was selling the S&Ps. It was breaking hard day after day after day, and I became more and more aggressive as I was doing this. So like in a week's time, I made like $40,000. Do you think I'm going to give them $40,000 back in a week on losses? No way. I make them take it back $1,000 at a time. So they got to beat me 40 times to get back what I made in that week. They never got it back, which is the bottom line. And that's because I was aggressive and I had the right side, and I realized this was a good period in the trading for that year. This was 4 or 5 years ago.